So anyways, that's the context for this chart I'm about to show you. So the question I got to thinking is there a way to really determine where we are in the big business cycle based on figuring out whether the money capitalists or the industrial capitalists have the upper hand, which is to say, which is more scarce at any point in time. Like right now, for example, is it money capital that's more scarce or is it industrial capital? All right. And I got to thinking, well, how do you measure money capital and industrial or commodity capital? And that's where I got to thinking. Here's the graph that we'll get to, by the way, in a second. But got to thinking, well, you would measure commodity capital in terms of GDP, but it's not good enough to use GDP in denominated or measured in fiat money because this fiat money has been debased, especially since 1971 when the U.S. went off the Bretton Woods system, which kind of loosely tied the dollar to kind of a loose, downgraded version of the gold standard. The dollar was already being depreciated kind of in the late 60s. We started having these gold runs on the London gold pool, and the Bretton Woods system was already collapsing at that point. But especially after 1971, you cannot rely on dollars to tell you honestly how much GDP growth there has been, because dollars have been inflated and the currency has been depreciated. Now, most economists will say, well, yeah, but you use real dollars adjusted for inflation. But no. This is not sufficient. And the reason for that is the way they adjust for inflation. And the way they do that is they take a basket of goods, usually consumer goods, although there are other various. There's the consumer price index, which takes a basket of consumer goods, or there's the producer price index, which takes a basket of typical producer goods that industrial capitalists would buy. All right. And they basically say, well, how much have these prices inflated? And we will deflate the nominal GDP numbers by that ratio. All right. The reason why that's not really sufficient, I think, for really gauging GDP growth is the fact that the production of these things really should be getting more efficient all the time as increased mechanization and automation make the production process of everything more efficient. Consumer goods, production goods, everything. And so you would expect with a currency that is maintaining its value, you wouldn't actually just see stable prices, you would see declining prices. All right, and that's what you saw during the gold standard. Typically, in a mature industry where things were getting automatized, you would see the production prices and the actual consumer prices of certain goods decrease over time as its production became more efficient. And as each new competitive firm onto the market tried to steal some of the market share by lowering the price down to what was basically the cost price plus a certain rate of profit, the average rate of profit. So this would drive down prices of things as productivity increased. So that's what you should see really with a currency that's holding its value. All right. So if you have a dollar that's maintaining its value when measured in the prices of consumer goods, that actually tells you that the dollar is still depreciating. All right, because those consumer goods should be getting cheaper. But if instead they're merely holding at the same price, even as the production of them becomes more efficient, then that tells you that the dollar is actually depreciating. And in these situations, that depreciation will not be detected by the usual measures of adjusting for inflation, or using the consumer price index or the producer price index. All right, so the real way that you need to use to adjust for inflation, for the depreciation of fiat currencies such as the dollars is using gold. All right, so the real way you want to measure world GDP is not in dollars, but in troy ounces of gold. Okay, this should be really our unit of measure to see whether, actually, here we go, whether world GDP was increasing or not. All right, and here you see world GDP has increased since 1960. It was at about 37 million troy ounces of gold per year. By 2015, we're up to about 70 million troy ounces of gold per year. And this is not the amount of gold that's being produced. This is the amount of commodities, the worth of commodities that are produced as measured in gold. Okay, if you want to look at actual world gold production in troy ounces, here you go. Actually, this is 37 billion rather. This is about 38 million gold troy ounces. You see here, 2015, we're up to about 96 million troy ounces of gold being produced. But in terms of commodities apart from gold that are being produced, how much are these commodities worth? Well, 1960, about 37 billion gold troy ounces. Here, 2015, about 70 billion gold troy ounces. So even measuring it in terms of gold, you can see there has been growth in world capitalism, but it's not been as spectacular as measured in fiat money, where you see 1.3 trillion all the way up to, 77 trillion, or something ridiculous like that. This is way overstating the growth of world capitalism. All right. And how do you determine how much world GDP there is in gold troy ounces? Well, you basically take the nominal GDP and you divide it by the price for each ounce of gold at the time. So you take basically the average price in any given year, because gold is very volatile, and some of these fluctuations are speculation and things like that over the short term. But over the long term, gold does respond to the fundamentals. So this rise in the dollar price of gold is not just speculation. I mean, I don't know how you can insist that it's speculation, this 55-year trend where the gold price of dollars went from $36.50 here in 1960 up to $1,100 an ounce now. I mean, does anyone really expect that gold is that it's on this huge bubble and it's going to collapse all the way back to $36.50? No. All right, it might go down just a little bit in the short term, but overall, I think this reflects a real depreciation in the dollar versus a stable measurement of value in the form of the commodity money gold. All right, so this shows you how much the dollar is depreciated. So you basically divide the nominal GDP in dollars by the dollar price of gold to get the world GDP as measured in gold troy ounces here. All right, so we have that. So this here is basically our commodity capital that's being produced each year in the world. All right, as measured in a real commodity money. Now, what about money capital? How much money capital is being produced each year? Well, that's this, the actual gold production, the production of this money commodity. So here we see both sides of the equation. All right, and then we can ask which is more scarce than the other at any given point in time, and thus determining, whether the money capitalists or the industrial capitalists are going to get to take away the lion's share of the profit rate. How much is going to go towards the interest rate if money capital is relatively scarce? How much is of the profit rate is going to go towards the profit of enterprise if it's commodity capital that's actually scarce? And what I did is I graphed these two, and this is what it looks like.